Great. So today we are going to look at the long-term decision-making techniques. So long-term decision-making techniques. Sorry, that's today's section. Long-term decision-making. In fact, we are done with the short-term decision-making techniques. We are going to do the long-term. Basically, we are going to talk about capital budgeting. That is the investment appraisal. So we are going to talk about investment appraisal. So investment appraisal. That's what we are going to talk about today. Investment appraisal. Then, in fact, we also look at the various methods to appraise a project. It's also called capital budgeting. Capital budgeting. That is investment appraisal. Good. So that is today's section. So we will use this week and then a bit of next week to clear it. Right after this capital budgeting, then we move on. Let me just three topics, then we are done with the entire program. So that's great. Good. Now let's go straight to the game. Investment appraisal and capital budgeting. This is the revision section or summary because you can use the first video for in-depth understanding. Good. Now, capital budgeting. At the end of each year, we have to prepare the budget for forthcoming year. Agreed. Good. Now, this budget, a part of it will determine the acquisition of capital assets that is ahead of us. Good. So here we should know the difference between capital expenditure and revenue expenditure. Revenue expenditure. Good. Now with the capital expenditure is the expenditure that you incur to acquire assets or to improve on the existing capacity on assets or improve the economic capacity of what an existing asset. That is what capital budgeting. So that's capital expenditure. So if you acquire new assets, or you improve existing, this is capital expenditure. Now, in management accounting, capital expenditure goes beyond you buying new assets or improving existing ones. We extend it to you making additional investments or you entering into different sectors. They are also what? Capital expenditure. I hope you get it. So capital expenditure in management accounting, we are going to extend it. Unlike the one that we treated in the financial reporting, where we said acquisition of non-current assets or improvement. Good. So here the capital expenditure, it includes investment into new business. So investment into new business. That's the capital expenditure, new business. Good. So anytime you want to enter into a sector or anytime you want to expand, so the amount you incur, the capital cost of it, we refer to it as what? Capital expenditure. That is the capital expenditure. Now let's talk about revenue expenditure. Now all the capital expenditure, their benefit lasts for more than one financial year. But with the revenue expenditure, they are the expenditure that you incur to just maintain the even flow of the economic benefits. So the expenditure that you incur to run the business on daily basis, that is what revenue expenditure. So capital budgeting, we are talking about capital expenditure. So here we have added one section to what we know under the financial reporting. And the financial reporting with the capital expenditure talks about the acquisition of new assets or improving existing assets. Here, investment into new business or entering into new business, buying assets, replacement of assets. That is all. So that's the capital budgeting. So capital budgeting is the budget when organizations are budgeting for their capital expenditure. The term that we refer to as is what? Capital budgeting. But before you budget for any project, before you include that next 2 years ahead of me, I will sell or I'll enter into a new business or even I'll buy new assets. The question is, you have to appraise that investment. You have to appraise that investment before you include it in your budget. So before you enter into any business, make sure that you have appraised the business well. Over here in financial terms, in what? Financial terms. So we have to appraise the project in financial terms, whether it will yield a good return in terms of profit or money or cash flow. So that is it. So it means that before we can finish or before we can budget for our capital asset or capital investments, we should appraise all of them first and know the one that will bring a lot of cash on the table before we include those ones in our budget that next year we have to enter into a new business or next year we have to buy a new non-current asset. So basically that is it. So that's why these two they are together. So if you are preparing your capital budget, then the investment this usually takes from an average of 3 years and above. Some even go beyond 3 years, 5 years to 10 years. So the project that is ahead of you from 5 years' time, that's all. So in short, capital budgeting is you making proposal decisions ahead of time, the investment ahead of you. That's the capital budgeting. But before you can include any projects or any investment in your budget, you should appraise it and know that it will yield a good return. So it will call for what? Investment appraisal. How we get it? So before we can include any projects in the capital budget, we have to appraise that project and see whether in financial terms it makes sense. In money terms, it makes sense. In profit terms, it makes sense before we can include it. Yes, because we are in to make profits and to maximize the shareholders' wealth. Good. So that is it. So we are done. So your question will be like this. If we want to enter into new business or we want to buy new assets for improvement, for now we will take it off. So love it, new asset and investment or new project. Maybe you want to set up a new project, it being the one that you thought about the other time. Yes, that business that you are thinking about. Don't start until you have what appraise it. Yes, to see the net income of that investment. So in exams, in short, the examiner will cite a scenario that suggests that the company wants to buy new assets or the company wants to enter into new business. So they'll give you information about it and then we will ask you, okay, management accountant, tell us or advise us whether we should go into that business or whether we should undertake that project or we should reject the project. Okay. So we will perform calculation and then at the end of the day, based on the results, we will advise management whether they should undertake that project or they should what, reject the project. How we get it? That's all about investment appraisal. So you're going to appraise investment, assess the investment, and see the validity. Assess the investment to know whether this investment is the best one or this investment is the good one. That is it. Good. Now, there are so many techniques that we use to appraise the projects. There are so many techniques. So we will start with the techniques. Good. But before that, we have to go through some few steps, and all of them will be, in fact, all of them, they are stated clearly in the first lecture. So you can go through that one too for a complete section. Okay. So it means that before we can appraise the project or the investment, we have to make assessments and estimate the details about the investment. The details for now, let's call it details. As time goes on, we call it cash flows. So the funds that you're going to receive and the funds you're going to spend on the project, put all of them together and you are done. Good. So we are going to list the method of appraising projects. Then we look at some few other stuff. So now let's look at the methods. So if you want to enter into new business, what are the methods that are available for you in which you can adopt to appraise or to assess whether the project is what viable in financial terms? We are done. Good. So let's see the methods. Now the methods, we put them into two. The profit section and then the discounted cash flow techniques. Good. So I'll list all the methods that we should pay attention to, and then the one that we will start with it first. Good. So method of investment appraisal. Method of investment appraisal. So the methods of investment appraisal, they are first method. They will look at the first two or first three. Good. Call it accounting rate of return. Accounting rate of return. And then two, we are going to consider payback period. Payback period. Good. Then three, we will consider, in fact, we'll enter into the discounted cash flow techniques. So from these sections are called discounted cash flow techniques. So, but in fact, I'll even write the three again. So the three, we call it discounted cash flow techniques or method. So discounted cash flow techniques or methods. So that is the third one. But just that, we have sub one. So the very first under the discounted cash flow techniques will be the net present value (NPV). So let me start with the adjusted payback period. So adjusted payback period. In fact, we can also call it discounted payback period. So adjusted or discounted. Adjusted or discounted payback period. Good. Adjusted or payback period. Good. Wow. Adjusted or payback period. Great. Adjusted or discounted payback period. So let me add the payback. Good. Then the second one is almighty investments, as NPV, net present value. Net present value. Net present value. Good. Net present value. Then we will talk about the very last one. Internal rate of return. Internal rate of return. Then we add that. That's IRR. Sorry. So sorry about today. We will call it what? Internal rate of return. So internal rate of return. Internal rate of return. Fact, we shortcut call IRR. And then NPV, ARR. Have you seen? Account rate of return, ARR. And then NPV, almighty NPV. Then this one is internal rate of return, IRR. Good. So these are the methods. As soon as you are done with this, you are done looking at some various issues. So this is the game. So we will start today with the account rate of return to collect from there. Then we'll quickly move on to payback period. And then I'll enter into adjusted payback. All of them are today. All of them are today. And we'll try and see if we can study MPV if possible. Then next section, we look at these two. Now, all of them, when you pick any of them, one, you should know how we use that approach or that method. to appraise the project, or how you are going to calculate what the project return using that approach. Then second, please, you should know their advantages, and lastly, the disadvantages. So advantages and what disadvantage of each of the method. So the methods are one, two, three, four, five. So basically there are four. Payback, just that we have the adjusted payback. So maybe they are one, right? So one, two, three, four, right? Good. So and basically in terms of return, just the adjustment to the NPV. So basically there are three projects here, or there are three methods that you're going to use. You have to make sure that at the end of this chapter, you should be able to appraise projects using these methods. And you should tell us the challenges or the importance of all of them. Good. All these ones, the discounted cash flow techniques have a particular good news. And then this one too have a particular challenge. So the challenge of this being solved by this. So we look at it. So now let's start with the accounting rate of return. Accounting rate of return. So we are going straight to the appraiser. The appraiser. We are going straight to the appraiser. So accounting rate of return. You are welcome. Accounting rate of return. So here, the idea is they're going to enter into new business or buy new assets. I want to appraise and see, I want to assess the project or the machine or the assets and see whether we should go ahead and acquire it. Good. So under the accounting rate of return, we call it ARR, accounting rate of return. Great. Here there are steps that we use. And then there are two methods that we are going to use. This is the method of appraising a project where we consider the accounting profit that will be derived from the project. We consider what? Accounting profit. So it's based on the accounting profit of that project. Accounting profit. Wow. That's the bottom line. That's the underlying factor. So put all the accounting profit that that project will generate together. That is, and use that one to assess the project. That one becomes what? The accounting rate of return. Good. I hope you get it. Great. So it's a method of calculating projects or appraising projects. Sorry, appraising projects or assessing projects based on what? The accounting profit that the project will generate. That is the accounting rate of what? Return. Basically. Now, we'll go through three steps to calculate the accounting rate of returns, like throughput accounting ratio, three steps. Or let me code the formula, then we look at the workings. First, you have to get the average profits. Average what? Profit. So first, so step one, You have to get average profit. Average profit. So average accounting profit. Let me make it clear. Not taxable profit. Accounting what profit. So average accounting profit. So yeah, the net profit that the project will arrive, or the profit that this machine or the asset will generate. That's all. Find the average. How do you get the average profit? Put all the profit together and divide by what? The number of years. Is equal to total profit divided by what? The number of years. That's the lifespan of the asset or the project's life. That is it. So basically, average profit is equal to total profit over the number of years. Over the number of years. That is the accounting profit or the average accounting profit. So put all the profit together and then find the average. That is it. So if you are considering investing project that will last for 5 years and you are going to use the accounting rate of return as the measure, relax. Get all the profit that this project will generate. Then put this profit together. Then divide it by the number of years. Then you are done. We've mentioned profits, accounting profit. Mention accounting profit. So take notes. Now let's go to step 2. Let me take this section off so I can do the step 2 there. Get the average investment. So average investment. The average investment. Average investment. Now, how do you get average investment? Average investment will be the initial investment or the initial cost of investment or the initial capital. So the initial capital investment or the initial investment. Can make it initial capital or initial investment. So initial cost of investment. Let me make it initial cost of what? Investment. Good. So initial cost of investment plus the scrap value. Plus what? The scrap value. Good. All of this divided by 2. Then we are done. So basically, to get the average investment, just put the initial cost of investment and add the scrap value to it, and then divide all by what? 2. What is scrap value? After the project life, maybe the machinery or the plant that you use, you can sell them. Maybe the project will last for 5 years. Then at the end of the 5th year, you can sell the machinery or the plant that you used in that project. So that is it. Now let's go to the game of the day. That is the accounting rate of return. So I take it off. So basically, to get the accounting rate of return is the answer in the step 1 divided by the answer in the step 2. So therefore, accounting rate of return ARR is equal to average profit all divided by average investment. Okay. Yeah. Good. All divided by average investment. Average investment. Times what? 100 because it's a rate. So that is the end of the game. Here there's alternative formula. So I will write that one also. Alternative formula can also be average profit divided by the initial costs of investment or the initial investment. So alternatively, this can also be termed as, we can calculate it like alternative formula. So that's the formula 1. So formula 3i, so that's 1. The second formula can be termed as this of special formula 2. Let me read it. ARR is equal to, still average profit, that one will not change, all divided by initial investment. Initial investment times 100. We are done. That's all. Now the only issue is this. Here we use profit. We don't use cash flow. So if you sell the produce from that project and then you arrive at cash revenue, you subtract your cash expenses, then left with the cash profit. But you're looking for what? Accounting profit, not cash profit. So you have to less other non-cash items such as what? Depreciation. So take note of what? Depreciation. So in short, to get a profit is a normal way of getting a profit. But because we want to make things look a bit different, we might not give you the accounting profits. We will give you cash flow. So you have to massage the cash flow to get what? The profit. Good. So that is it. So in short, if they're giving us the cash flows, then that means we have to subtract depreciation and other non-cash item. Here, the non-cash item that we are going to use will be the depreciation. That was normally we are going to use to worry the depreciation. So take note that we use profit, not cash flow. So in the question, we have given you a cash flow. Convert that cash flow into what? Into profits. That is all. Good. So we'll pick our first illustration. I'll solve 2 illustrations there, and then we are done. So when they give you the question, all what you need, there are 3 items. When the examiner give them to you, you are done. First, they have to give you the accounting profits. 2, the initial investment, and then the last one is the square value, and then the number of years. That's all. So even the question is plenty, these are the items that you're going to look for. Then you are done. Good. So now let's look at for our first example. So help me cite this example. So here I write it small here. So this word I write the question. I'll summarize it. I'll not include a lot of items, no. Good. I'll not include a lot of items, only few of them. Then we add them. So let's assume that we want to buy a machinery, a piece of what? Machine. So we want to buy a machine, or let's say a plant. So plant at the cost of. So the introduction will be iodine limited, iodine limited, or iodine limited. Yes, hard. Yes. Okay, the question iodine. So iodine limited is considering buying a plant costing, so plant costing what? Costing 100,000 with an estimated useful life of, let's make it 5 years, with a scrap value of 10,000 Ghana cedis. So that is the question. Below is the estimated below is the estimated below is the estimated net cash flow from the asset. So let me put it here. Cash flow, and then the year. So year one, year two, year three, and then year four. So here will be okay. Year one, the cash is, in fact, you are going to get 150,000 cash flow, net cash flow. That's the first year. Second year, forget 140,000 Ghana cedis. For the third year, things will be very good. We will get 200,000 Ghana cedi. For the last year, the fourth year, things are a bit not okay. So we nearly had a loss, but we managed and we had a net cash flow of 10,000 cedis. Full stop. Required. Calculate the accounting rate of return. So This question is the one that we have to do justice to it. Good. So we have to do justice to this question. That's great. So basically, this is our first illustration. Now, first we have to get the total profits because account rate of return we need what? Profit, not cash flow. So account rate of return we need what? Profit. Now you've come across accrual and a cash basis, right? How to convert them. The difference is a non-cash item. That is the typical example is depreciation. So check. If they give you cash flow, that means depreciation is yet to be what? Subtracted. Or depreciation have not been deducted. So we have to deduct the depreciation. So therefore, let's start again. Here we are just calculating what? The accounting rate of return. So calculation of what? Accounting rate of return. Let's do it at top here. So accounting rate of return. Good. So first, I'll put my year here. So year one, year two, year three, year four. Oh, I said year five. So let me add one more to it. Sorry. Let me add one more. For the last year, we had a loss. Let's add one because the asset will last for how many years? 5 years. But I've used 5 years to do the calculation. I've used 5 years to do the calculation. So let's assume that the fifth year, there's a loss of 5,000. Great. So you can capture the question. The last year is a loss of 5,000 for this. Great. Sorry. So let's include loss of 5,000 in the last year. Great. So now let's see here. We know that account rate of return, we need what? Profit, but not what? Cash flow. We need profits, but not cash flow. So this cash flow, we have to convert it. In short, to get the profits is the cash flow, the net cash flow minus depreciation or minus all the non-cash item, non-cash expenses. Because this one is a typical accounting profit. So they're supposed to give us the sales revenue, the cost of sales, so that we get a gross profit. Operating cost, then you get operating profit. Add other income, you get your profit before interest and tax. You have to give out the finance cost. We take it off. We get what? Get a profit before tax. They give out the income tax expense. We take it off in that order. That is the accounting profit. Good. So let's see. So the cash flow less the depreciation. So calculate the depreciation for me. But I'll use two different methods, and then you will like the second approach. Yes, you will like the second approach. Now let's see. First, we have to bring the cash flow here. Tell the examiner that I have to take off depreciation from it. Tell the examiner that this is the profit. Good. How we get it? So therefore, we have to put this one here. Don't forget your Ghana city. So let's record the profits and then less the depreciation. Good. Now, the first year profit is one. So the first year cash flow is 150,000, 140,000, and okay, that's 200,000, right? And here's what 10,000. In fact, the last year they had a loss of 5,000. Put in brackets. So the cash outflow was more than the inflow, giving a net cash outflow. Now let's see. So the question is, we have to go and calculate the depreciation. So let's do the calculation here. Depreciation. Let's use the straight line method, okay? That tends to look okay. But whichever method that you use to calculate the depreciation, the final answer will be the same. The depreciation policy will not affect the calculation. So to be on safer side, use what? The straight line method, so that tends to be straight for you or will be a bit simple. So depreciation will be the cost of the assets, which is 100,000, less the scrap value of 10,000. Normal way of calculating depreciation in accounting books. That's the so let's now divided by 5. So what will be the answer? Divided by 5. So 90,000 divided by 5. Any answer for me? So 90,000 divided by what? 5. That'll give us 18,000, right? Okay. So each year's depreciation is what? 18,000. That's great. So that means we have to subtract 18,000 from all these profits individually so that we can arrive at what? The profits. Good. That is perfect. So let's record the depreciation. 18,000 drop. 18,000 drop. It's a normal way of calculating depreciation because we are using accounting profit. Normal way of what? Calculating profit. So now this is the profit. So the first year, what will be the accounting profit? Accounting profit. You subtract, so you get 132,000. And then the next one is 122,000. Two. Here to be what? 100 and 82,000. And the fourth year, what will be the answer? The fourth year's answer. Good. So 10,000 less 18. So it's left with what? 8,000 minus. You put in brackets. That means tell us. Just put it in brackets. The last year to be what? 13. Loss of 13,000. That one also. Put it in brackets. We are done. Now what you have to do is this. Just have to sum them up. This is what we need. And we are going to just use one shortcut approach to arrive at this figure. So kindly get the totals for me. And let me put them in. Good. So the one that, so please, the last year it will be 23,000, not 13, because we are lessing 18 from minus 5, so to add up to 23,000 negative. Great. I like that. So the total profit, is 405,000, and 90,000, then 4. Good. So when we take 90,000 from that of 405, what do we get? So the cash flow will be good. So let's check the calculation. This is 495, right? Okay, then I'll take that. So 495,000. Okay. So the total profit, then I'll take that. Great. Great. Now let's see. Under exam condition, this is what a long student to do. Yes, there should be a very easy approach for us. This total depreciation, we can get it, because that was the issue. So we don't need to go through this calculation. This calculation can be what? Avoid. Standardism condition, that section, don't try. Just time consuming. But we did the analysis. So assume you don't have that section. So you get a total. So just add all the cash flow together. Then say less total depreciation. Less what? Total depreciation. Now, total depreciation is nothing by the cost of the asset less the scrap value. That's the depreciable amount. That's the total depreciation. Is the cost of the asset 100,000 less the 10,000. That's the total depreciation. That's all. If there's no scrap value in the question, then the entire cost of the asset becomes what? The total depreciation. If there's no scrap value in the question. So you are bringing the 90,000 here nicely. I'm assuming this section you are not going to do it. So therefore, what is the accounting profit? So total profit will be, we take the 90 out of the 495, and then you will get 405. I hope you get it. So let's kindly work with the second approach, and then you'll be fine. So profit. So total profit will be total profits. That will give us 405,000. That is the total profit. How many years are we traveling? How many years are we going? We are going for 5 years. So what will be the average profit? What will be the average profit? So we have to get the average profit. Good. Now let me take this section off. I hope everyone have the question. If you don't, kindly take a snapshot of it. Good. So continuation. I am continuing from this section. So therefore, average profit will be, how do you get the average profit? I'll open my brackets. Who can tell me the formula for finding average profits? Formula for finding average profits. Formula for finding average profits. Is that? Okay, average profit. It will be the total profit, which is the 405 divided by what? The number of years. Yes, I'll take that. Go, divided by the number of years. So therefore, the total profit is 405,000 divided by 5 years. That is the average profit. So right from this answer, you just have to pick it up. I like that. That's great. So average profit is equal to 81,000. Then what about the average investment? So copy that one thing for me, and let me pick it up. So good. So the average investment is equal to initial investment plus the scrap value, all divided by 2. So that's the average investment. So we will have the initial investment of 100 plus 10 divided by 2. So 55 Ghana cedis. Okay. That is the initial investment. Great. So now let's calculate it here. So average investment, is nothing by the initial of 100,000 plus 10,000, all divided by 2 years, or 2, that will give us 55,000. So therefore, the accounting rate of return will be 81,000 divided by 55 times 100. Then we are just calculating what? I'll massage this question and bring it back again. So it's equal to 147.3%. We are done. So we are done with the calculation. Now let's look at some few issues about it. Then we are done. Now let's look at the acceptance criteria. So the next topic is the acceptance criteria of accounting rate of return. How do you select? So after you calculate, or after the calculation like this, what will be the decision? Are you going to reject it or you are going to accept it? Good. That's great. So the average investment is the initial plus the scrap value all divided by 2, as in a constant 2. Good. As in a constant 2. So always to be 2 years. But the average profit will be the total profit divided by what? The number of years. That one will be what? 5. Now this is the accounting rate of return. Now 11, 2 to 3 issues. Then we are done with the accounting rate of return. First, let's look at this issue. Issue number 1 is the acceptance criteria. So that's the subheading. Acceptance criteria. Acceptance criteria. That is the next section. Acceptance criteria. Good. On what basis do you accept the project? Now you have to compare this one to your internal ROCE or targeted ROCE. That is it. Targeted ROCE or the internal ROCE. So you compare your accounting rate of return before you accept or reject the project. First, relax. Get the accounting rate of return. After that, relax. Then compare these to 2 items. Any of them. So let's see. We call it acceptance criteria. On what basis do you accept project using accounting rate of return? Is it when it is above 100% or below 100%? No, not at all. It's like this. Now let's look at the acceptance criteria of accounting rate of return. Acceptance criteria. So first, you compare it with the 1 target ROCE or the internal ROCE. So first, this must be compared with the target ROCE. So compare the accounting rate of return with what? With the following item. So with the target, but wherever I see targets, I write it with Vim. With the target ROCE. ROCE is return on capital employed, or the internal ROCE, or internal ROCE, or just the ROCE. ROCE is the return on capital employed. So decision rule. So what will be the decision rule? Decision rule here. I'll use red pen to write it. I wish I have red pen here. Let me see if I have red pen here. No, no red pen. Decision rule. Accept projects with accounting rate of return higher than the any of these items here, the receipt. So accept projects where what the accounting rate of return is what is higher than the receipt. So projects with projects. For the decision rule, we have single project and multiple projects. So I think I'll explain that. Sorry, forgive me for today. The position of the cam going the receipt. Accept the projects. To accept projects with the ARR being greater than what the receipt, or with higher ARR, where the ARR is what the ARR greater than receipt, return on capital employed. This one, let me explain a bit of it for you to get a detailed understanding. Now, for those of you who have a fair idea about ratios, there's one called ROCE. That's Madam what? ROCE. Return on capital employed. Now, internally, if the capital that you are using to run your business, you are paying investors at least a 80% per annum, or let's make it 30%. Maybe that's your target ROCE. You are paying your investor at 30%. Then that means before you will accept any project, that project must pay you more than 30%. Agree? Yes. The issue is this. I have taken money from investors. They've invested in the company, yes, and we are giving them 30% return. And now we say we are going to invest somewhere. That investment must give us more than what 30%, because we are going to use the invested money to go and do that deal. So whatever we get, we are going to share. Give their 30 to them, the remaining balance, we keep it for the organization. So that's why the project that we have to accept, the accounting rate of return must be higher than the ROCE, the return on capital employed. For instance, something like this. Yeah, we had 147.3. So that means if our ROCE is 30%, oh, then we should go and then accept it, because after receiving or earning 147, we can still pay the 30 to those who have provided finance, and we still have more. So that is the issue. Now, the internal ROCE and then the target ROCE, even though the internal ROCE might be there, sometimes the company will have a target. Will tell you that even though my internal ROCE is 30%, but I'll not accept anything smaller than 50%. That's it. That's the target ROCE. What your expectation? Even though our level is 30%, we are paying our investor 30%. We should not accept anything below 50%. That's the target ROCE. So have you seen the difference between the target ROCE and the internal ROCE? The internal ROCE is just the normal ROCE. That's the return on capital employed. The returns that you are giving to your investors, those that are giving you money to finance your business, what you are giving to them back. That's the internal ROCE, which is 30%. Then you tell yourself that, okay, Me, I'll not accept any project if you can give me more than a 30% to. If you can give me 50%, I'm okay. So at least, or maybe 200%. If it's 200%, then this project must be rejected. How we get it? Because the target we see is for 200%. But this project is giving us 147. So you have to reject the project. So that is the acceptance criteria. So each of all the appraisal techniques please three items: the calculation, importance and limitation, and finally the acceptance criteria. On what basis do you accept what project? Based on that method, then we are done. So good. So that is the accounting rate of return, the decision rule. So before you can make decision, they have to give you the ROCE, whether the internal ROCE or the target ROCE. So when they give you all the two, then use the target ROCE. So that's what they are pegging their standard against. So that is it. But if the examiner just asks you to calculate the accounting rate of return, you just have to compute it for him and then you are done. As to the decision, it's a different requirement. Good. So basically, that is the game. Now let's look at the advantages and then some few challenges that we have with accounting rate of return. Advantage. It have a good news. One good news. The good news is that accounting rate of return, as the name suggests, accounting rate of return, we also call it return on investment. Accounting rate of return is also called return on what? Investment. So you can also call it return on investment. Accounting rate of return is also called return on investment. The good news is that it uses what? Accounting profit. That's the very first good news. It uses accounting profit. You know, accounting profits are commonly known than the taxable profit and then the other types of profits. Good. So now let's look at the advantage and then the challenge. So the first good news about accounting rate of return is what? The accounting rate of return uses what? Accounting profits, which is easy to what? To be determined. Good. Because most of us are accountants. Yes, so we can determine the accounting profit easily. If I ask you to determine the taxable profit here, it will be an issue. But the accounting profit, at least you can find a way around it. Good. Second, the accounting rate of return is easy and simple to calculate. No complex calculation here. So within some few minutes, we are done. So that is it. Now let's look at some few challenges with the accounting rate of return. So if look at the good news, as the time goes ahead, by the time you finish, I'll give you all. We'll be adding it stage by stage, and then we are done. So we'll be adding it stage by stage. Good. And then we are done. Good. Now we said that the advantage, number one, it uses what? Accounting profit. It uses accounting profit. What make it good news? If you mention accounting profit, you not mention anything. Yes, it's not easy to be determined because most of us are aware of accounting profit. Good. So that is so simple. and easy to understand and easy to understand. Good. Now let's go to the challenge or the limitations of accounting rate of return or disadvantages. The limitations, the few challenges of the accounting rate of return. In fact, that's a major issue. Major. Have you seen this major good news? That's the same thing. It creates a challenge. You know, accounting profits are subject to manipulations, right? Yes. The accountants and then the other management can manipulate what the account. So it will also affect what the accounting rate of return. So it's subject to manipulations. And then two, changes in accounting policy must also influence the accounting rate of return. Changes in accounting policy will also influence the accounting rate of return, might have impact on the profits. Because if you change the profits, if it the validity of the accounting rate of return, or it might not help us to make an objective conclusion. So changes in accounting policy might not help us to make an objective conclusion, or might influence the validity of the accounting rate of return. How we get the point? Good. So today you are using this policy, the next day different policy. This one will not help you to determine the profits and hence determine the profit well and hence proceed for the calculation. Now all the items, there is some general limitation that runs through all of them. So I'll give you the general limitation. What we've done is a specific limitation. So by the end of the chapter, I will give you the general limitation. That one runs through all of them. Whether accounting rate of return, whether MPV, all the appraisal techniques, all of them suffer the same sickness. The sickness is common. It's like COVID. Yes. Almost every country. Good. So that is it. So that challenge is what? It's a pandemic. It affects all the method. Okay. Now we are done with the accounting rate of return. What left is I have to give a question. So I'll project a nice question for you to try it for me. Then I'll start with the payback period. I will use the same question that we solved. So kindly produce the question to me. I can't remember anything about the question. All what I remember is the last two figures are what? 10,000 and 5,000 negative. That's the only thing I remember. Good. So we are done with accounting rate of return. So let me go to the payback period. Payback period. Then we are done for today's game. Today, only three methods. Then the next time, look at three methods. Then we are making what? Headway. Payback period. You are welcome. Payback period. Payback period. This is a duration. Payback period is what? Duration. How long will it take the project to pay the capital sum or to pay all the expenditure or to pay the cash outflows to you? So that's the payback period. So the duration, the period in which the project will take to pay or to arrive at the full cost. So all the costs that you're going to incur, whether capital cost or revenue expenditure, how long will it take the project to pay you back? That's all. That is payback period. Payback what? Period. It came a certain before last sitting. So a sitting before last sitting is what? November 2019. And you're writing when? November 2019. Okay. History must repeat itself. Okay. So basically that is it. So if you have a project, let's assume that the capital investment is 30,000. Every year, this project will give you 10,000 Ghana cedis. How long will it take you to recoup your money? What you've invested? You have invested what? 30,000. So how long will it take you to recoup the capital cost? How long will it take you to recoup the capital cost? So it will take you 3 solid years because every year 10,000. So at the end of the third year, the project will pay back all what you have invested. So the project payback period will be what? Will be 3 years. We measured it in years. That's all. Now, all what you have to take care is payback uses cash flow but not profit. How you are getting it? Payback uses what? Cash flow. In fact, all the appraisal techniques, only one of the method that use profit, the rest uses cash flow. Which of them uses profit? Accounting rate of return, very good. It uses what? Profit. That's the accounting profit. Aside that method, all of them, they use what? Cash flow. All the other method, they use what? Cash flow. So payback will use cash flow because you're looking for how long the project will pay back the cash flows or cash outflows. That's all. So let's use the same example that we saw. The same word example. So if capital cost will be all right, everything is straightforward. Capital cost is 100,000. The scrap value will be the number of years is 5, but they have given us the cash flow. Kindly let us reproduce the cash flow. So the individual cash flows. So year 1, 2, 3, and 4, then 5. So year 1, the cash flow, I think it's 150, 140, 200, 10, and 5 negative. Yes. You're using the same question without changing anything. And let's see how it will affect. Now, this is the question. So let's bring it here. First, you have to estimate the last year cash flow. Good. The last year, if there's a scrap value in the question, kindly add it. If there's a scrap value in the question, you can only do what? Add it to the last year's cash flow. So in this question, the last year, the cash flow will increase. Why? Because the scrap value too is a cash flow. Scrap value is what? It's a cash flow. Inflow. That's why we are adding to it. So it will be positive 5,000, right? To move it from positive 5,000. And for this project, it will pay back within a year. So I want to change something. I want to change something. For this project, in fact, we had 147, which is abnormal. 147, I can't do it of 10. It's a bit abnormal, so but I'll make some changes. Good. Now let's change this one to we had 400, right? We had 400. It's 495. So 500 505. So let's assume that this one is 490,000. 490,000. 490,000. That's the project cost. Please get how we are going to calculate it. There are several approaches that you may adopt, but try this one for us, okay? Good. I may try the other alternatives for you. This is where the cash flows are different. So here, just record the year and record cash flow, and put the balance there. And put the balance here. That's all. And put your Ghana cities, by quarter cities. That one is start from ESL. Yes. Now, ESL means now, today. Today, that's ESL. Today, ESL. When you are making the decision or you are estimating the cash flows. Okay. So year 1, 2, 4, 5. Great. Now what are the cash flow? Year 0. It must be what? The cost of investments. You put that one at year 0 with negative. So 490,000 cities. Then you put it in brackets. Year 1, the cash flow is what? 150,000. Agreed. That one is positive. Then the year 2. Year 2 will be 140,000. Why have I split it like that? So that's the shift here. Then year 3 is what? 200,000. Year 4. Year 4 is what? 10,000. Now when you go to year 5, relax. Minus 5,000 plus what? The scrap value of what? 10,000. Add the scrap value. Why are you adding the scrap value? Because you're looking for the total cash flow. Cash what? Flow. And here will be 5,000 positive. Why? Because we have because we have negative so negative 5,000 plus 10,000 will give us the 5,000. Now, this we are just reproducing the items in the question here. That is all. We are just reproducing the items in the question. That is all. Good. Good. Now, what we have to do is this. We have to get the balance. Okay, this one is not part of the solution. No. The lines are not part. Because my hands are suffering from opumiasis. That's where I read the line so that I can see. I don't know. The 10 upside down. Now, first, what's the balance? The balance is still negative 490,000. So, at the start of the project, we have 490,000 to clear. At the end of the project life, year 1, the project gave us 150,000 Ghana cedis. And we are going to use it to offset what we invested in a year ago or what we invested in year 0. So therefore, it will be, what will be the balance? We are offsetting. We have a negative 490 to clear. I have a positive 150. We are taking this one from this. No. We have, okay, so negative 490 plus 150. Good. So just in short, you are just taking this one from that figure. You usually offset it. So 350, right? So 340,000, and it will still be what? Negative, right? Great. It will still be negative. Then we take it's negative 200. Sorry, I'm not happy. So here it's left with negative what? 200. So the third year, you get 0. I like that. So what's the payback period? So how many years, how many months would this project pay back? So it means that the project will pay back when? Exactly 3 years. Okay, 2 years. Where you had a 0, that's where the project will pay back. We had a 0 at what this year, so we circle where we got a 0. That is where the project will pay back. Agreed. So here, therefore, the payback period is what? 3 years. Now, I will do some changes, but before that, let me write the acceptance criteria. The acceptance criteria. We have for single projects and we have for multiple projects. With the account rate of return, we said that accept the project if what? The account rate of return is higher than what? The target will see or the internal will see. What about payback? Payback, accept project that will pay back. Wow. Project that will do what? Payback. That's the single. You have a single project. This project is just a single project. Accept it if this project can pay back. That's all. When the year is not an issue, what matters is this project can pay back. That's all. Exactly when it will pay back, we don't need to worry. So that is it. Great. So accept project that will pay back. So this project, should we accept it or we should reject it? Because the project can pay back. We have to accept it because it can what? Pay back. And the payback period is what? 3 years. Where we had a zero. We are done. What if we have multiple projects? What will be the acceptance criteria or the decision rule? If it is multiple projects and you're using payback, then accept the project that will pay back within the short possible period. How we get it? The project that will take a shorter time to pay you back. That's all. Accept that project. That is it. Now let me make some small changes. Then we are done. Small changes. I'm going to change this figure because the answer was flat 3 years. I don't like that. Let us assume that here is 196,000. 196,000. So tell me, when will the project pay back? So 3 years, 196,000. And here still 10,000. Everything is to remain the same. So when will the project pay back? So you realize that here we need 200,000 Ghana cedis to clear off. We need 200,000 cedis to clear off. But the funds that we have at the end of the third year is what? 196. So it's not enough, right? So we step down. So now let's step down. So left with what? 4,000. Agreed. So left with negative 4,000. So you step down. In the fourth year, we had what? 10,000 Ghana cedis. So that 10,000 cedis, we use it to offset. So here, the payback would be what? Dash. Put dash here. Ignore the remaining figures. As soon as it runs to zero, that's all. We are done. So now who can tell me the payback period here? The payback period will be what? So who can tell me the payback period? Okay. So in this case, this is how you are going to calculate the payback period. An event like this where it is not flat as the first one, which was what? It was on it. So that one will be just 3 years. But here, we did not pick all the 10,000. You pick only what? 4,000. So therefore, the payback period will be, I'll write it in three folds, three different approach. Method one, all in years. But payback is duration. So you can express in years, months, days, or mix. Some are in years, some are in months, or some are in years, some are in days. So these are the difference. So if you want all in years, then to be, so the payback period will be equal to 3 full years. The fourth year is not full because the entire funds is what? 10,000. I use only what? 4,000. So left is 6,000. So you have to what? Prorate it. So 3 full years plus what? Here, how much that pick from this 10,000? You pick 4,000 from this 10,000, right? Good. So therefore, to be 4,000 all divided by the entire funds. That's all. So this answer will give you the payback period. So what will be the payback period? So the payback period will be 3 years, 4 months. Okay. Okay, so here is 3.4 years, right? Agreed. Okay. Now, I like that. I like that. 3 years, 4 months, eh? Okay. Okay, so what if it's like this? 3.456789. So they'll tell you that 3 years, 4 months, 5 weeks, 6 days, 7 hours, 8 minutes, and 9 seconds. Right? No, we will not go by that approach. No. Okay, now let's express it some in years and some too in what? Months. If you want some in months, it will be 3 whole years plus 4,000 out of what? Out of 10,000, like this, times what? 12 months. So multiply this one by 12. Let me take this section from here so that, so to be 4,000 out of 10,000 times 12 months. So this one alone will give us the month. So 4 out of 10 times 12, what will be the answer? What will be the answer? So if you want to express some of the period or some of the duration in years and months, the first one, make it years. So that's 8, it's 4.8. So the nearest whole number, so that'll be 5 months, So it will be 3 years and 8 months. I'm not sure. Dot 4 will not give us 8 months too. Oh, okay, it's 4, right? So 5 months, 3 years, 5 months. Good. So 3 years, 5 months. So that will be, or you can still express this one. Just multiply 0.4 by 12. Whatever answer you get, that's a month. Good. Because 1 year might not be equal to 1 month. So that's why that approach might not work. So if you want to express it in years, just remove the point, the decimals, and multiply just the decimal by 12. It also inform you about it. Good. 3 years, 5 months. We are done. What if I want to express it years and in days? Do that one for me and let me see. Good. So try that one, let me see. Then I'll pick everybody's answer. So it will be, if you want it in days, just multiply this one by 365 days. So 365 days. And now give us 3 years and what? Something days, right? 146 days. We are done. Perfect. Yes, I'll take that. Perfect. So that is it. I'm done with the payback period. I'm done with the payback period. Now, let's look at the advantages and disadvantages. Then we are done for the day. Advantage of the payback period. It have a great advantage. The very first one is that it uses cash flow, but not what? Accounting profits. That's the good news. It uses what? Cash flow. Cash flow is not easy to be manipulated. If you have thousand series, it's thousand series. You can't tell me that. And then the thousand, it looks like it's thousand, but it's not thousand. But according to you, it's 900. No. But if you're calculating for the accounting profit, some of the items are estimate. Cash, you can't estimate cash. So if you have received it, you have received it. If you have not received it, you have not received it. That's the end. So cash flows are not easily manipulated. Good. Two, two. This helps us to estimate the duration or the period in which the project will pay the capital sum back. That's another good news. Because the account rate of return, we don't know whether the project will pay us back in year one or year two. But with the payback period, oh yes, we can be able to determine that. Good. So we are saying that the payback period helps to determine the duration in which the capital sum will be recouped or recovered or will be repaid. Good. So that is it. In fact, all of this has been clearly stated in the materials that I compiled. So I think when we go further, you look at it. Now let's look at the challenge. It's a two strong challenge. In fact, let's make it three. I'll make it three. Payback period. Challenge number one, or the advantage, sorry, the disadvantage. And then we are done. Disadvantage number one, it ignores cash flows after the payback period. 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 Let's back with the illustration. Have you seen here? This project, it pay us back here. Leave it 6,000 here. We have ignored it. Leave it 5,000. Ignore. That's a challenge. That means we don't use all the cash flows. Challenge number two. Challenge number two. It ignores the time value of money. It's a very great challenge. It ignores what? The time value of money. And then that one too is also a challenge under the accounting rate of return. So the same figure will be, or the same statement can be used under the accounting rate of return as also a challenge. It does not take into consideration the risks associated with the cash flow. So it's the same point that it does not consider the time value of money. You know, one city today is not the same as what one city tomorrow. Or what 10,000 Ghana city can buy today in future, no, cannot buy. You need more cities to buy the same item in future. Good. So that is it. Then we will talk about the last one. You know, payback may end up rejecting profitable investments. Profitable what investments. Assuming that this project, most of the after the payback period, the cash flows over there are very huge. And then because we ignore the ending cash flows, you may end up reject a profitable investment. Let us know this one is let's say 500,000 Ghana cedis. That this figure is 500,000. Have you seen this 500,000? It's even more than the capital sum. The last year figure is even more than it. Still, the payback period is 3.4. It has not changed. Still, the payback period is what 3.4 because you don't even get to that point. So if there was a project where the payback is let's say just 2 years, in fact, you will go for it and leave the one with a long period. So you may end up sacrificing the profitable project because say you want your interest is the one that can pay back, not the one that can give you what huge money. That is it. Good. So we are done. Now, what left is the adjusted payback period. I'll do that when we start the discounted cash flow techniques. So, unfortunately for us, this is how far the good Lord will bring us. Orlando, we will continue. Please use the videos that I will arrange. I've done that. I will upload it on a platform. Kindly go through all of them. I'll send them right now. For that one, they are ready. Please use that one so that when we meet, we are only solving questions so that we can move fast. Okay, good. Humble suggestion: if you have not subscribed to the page, kindly do so. And please, the video watch from start to the end. Yes, the video watch from the start to the end. Some people watch and then, in fact, before they get to the end. Yes, to get a full picture from the start to the end. Good. So I have to give a work. I cannot finish everything with that. Yes, giving a work, it nearly escaped me. So let me project the work. The same material. If you get a question, you can take a snapshot and then forward it on the page for us. So we are done for the day. So basically, that is the topics. Now let's see. So can we go through all of them? Then you are fine. The methods. Yeah, done with this. So at least fact. And here, thank God, they are solved uh, questions. They are solved questions in it. So that's good news. But okay, so example 3 is yours. Example 3. Example 3. You are calculating both the payback and what? Accounting rate of return. That's what I require from you. That question is a very interesting question. So example 3 is yours. In fact, that's all. I'm done. The remaining one we will continue on Thursday. Example 3, page 9. Page 9. That's all. That's all. Good. So we are done for the day. So thank you very much.